Listen, I'm a simple guy. All I want is to find the world's greatest portfolio, one that balances risk and return in multiple asset classes, one that'll perform even in a bad market, one that women want and men admire. So I built a financial model that tests a set of 50 possible allocations of crypto, bonds, and stocks to find the very best. And I did it. I found the very best performer. And the reason this is important is because portfolios are like toilet paper and pickles. They're not all created equal. Some are just flat out better. Put it this way, we have portfolio A and B. Tell me which you'd rather choose. They both have an expected return of 9%, but portfolio A carries double the risk. Which would you rather invest in? Unless you like rolling the dice on life, you'd probably choose option B. But believe it or not, this actually happens in real life. Your own portfolio could very well be far riskier than it needs to be. And this is called the Sharpe ratio. It's perfect for comparing portfolio types. It takes into account an investment's potential future return compared to that investment's volatility or total risk. And if you're kind of a nerd like me, here's what the actual formula looks like. You take each asset's average expected return and weight within a portfolio, subtract the risk-free rate, which is the return that you can get investing in essentially risk-free assets like treasury bills. Then you divide that by the expected risk of the portfolio. This is how much the price can sway, how volatile it is. The more diversified, the less the risk. If you feel lost, don't worry, this will all clear up in the next few minutes. And by the way, this entire research report in far greater detail was available to members of Finova way before this video was posted. So if you'd like access to that, plus live coaching calls every single day, it's insane, trade signals every single day, and much, much more, just go ahead and join the best damn finance group on the planet, linked in the description below. Also, we're currently running a 7-day free trial, so try it out for yourself and just see how you like it. Now back to the big idea. Some portfolios are flat out better than others. This is based on expected returns compared to risk. On this graph, we can see a bunch of dots. Each one represents a different portfolio with different allocations of the same assets. For example, you could have a portfolio that's 50-50 stocks and crypto, or you could go with 75-25 stocks and crypto. They have the same assets, but the expected returns and risks are vastly different. The further right a dot sits, the riskier it is. The higher the dot sits, the larger its potential return. So all the way to the right and all the way to the top would be the highest risk and highest potential return. Bottom left would be the lowest risk and lowest potential return. And you've probably also noticed on this graph we have kind of a boob-shaped line. If a portfolio dot falls on this line and has a blue color, it's considered efficient. It maximizes relative return as well as risks for those particular assets. Dots not on the boob line are always inefficient. You can do better if you get back on the boob. Check out P1 and P2. They have the exact same risk as measured by standard deviation on the bottom, basically how much prices can change. However, P2 has a much higher expected return. So of course, any rational investor would rather P2. This is why it's insanely important to understand this. Then we can take this one step further. For any combination of assets, there is exactly one, count them, one combination, 1 point on the boob line that will have the best possible risk-reward ratio. This point is considered Sharpe ratio maximized. Here we can see on the updated chart that that point is now colored green. And now that we discovered the best portfolio possible, we can mess with it a bit. We can fiddle with the risk and potential return here. So let's say you wanted to lower risk in your ideal portfolio. You could do this by making an additional investment in treasury bills. These risk-free assets currently have a return of 3.25%. So on an extreme, if we were to invest 100% in T-bills, we'd see that 3.25% return. This is marked in purple on the graph. But even more importantly, it creates what's called a capital market line. Put simply, that just means any portfolio on this line is the highest expected return for any desired level of risk, aka volatility. It's the best of the best for that particular level of risk. So if you want less risk, you simply purchase more of those risk-free assets. If you want more risk and more potential return, you would take out a margin loan to buy as much as possible of the optimal portfolio. Okay, I know that can be a lot to take in at first, so feel free to watch the last few minutes twice or even 3 times until it all sticks. Or maybe you just want to take another look at the boob line. I don't judge. For whatever reason, you need to rewind. This all took me a while to understand as well. But what's most important to understand is that any investment along along that CML line is the most efficient use of your cash in those particular investments. You just decide how much risk you want and change your portfolio based on that. Now we can take our newfound knowledge of the optimal portfolio and place it into a real-life use case. This will help us determine what data says is the actual ideal portfolio. I wanted to figure out the perfect allocation into crypto, stocks, and bonds. In order to do this, I first needed to do some simplifying. I don't have some kind of supercomputer that can calculate every single crypto portfolio possible, so I'm using Bitcoin as a proxy for all cryptos. The reason I felt comfortable with this is most all cryptos are highly correlated with Bitcoin. Bitcoin has this kind of gravitational pull. If it goes up or down, so does basically every other coin. Here we can see not only are many cryptos correlated to Bitcoin, but also correlated to one another, where the correlation to stocks and gold are much lower. Beyond this, I'm using indexes as proxies for stocks and bonds as well. Okay, we made it. Now we can look at the 50 different stock, crypto, and bond portfolios and compare them to find the very best. I even included some portfolios that are short Bitcoin to try and just include everything possible. So these portfolios range from 65 to 40% stocks, 45 to 20% bonds, and negative 10 to 39% crypto. And the first thing I noticed when running these calculations, and maybe you would have guessed this, but a higher allocation into crypto meant expected returns as well as expected risk increased dramatically. This is thanks in part to the wild price swings Bitcoin and other cryptos can have. Here we can see an increase from a 1% allocation into Bitcoin to 25% actually increases relative portfolio risk by double, but at the same time, it increases the mean return by 3x. So basically, you gotta risk it for the biscuit. Now, what are the best portfolios out of these 50 options? First, we have the minimum variance portfolio. This is the one that maximizes performance while minimizing risk. The allocation here is 1% crypto, 39.5% bonds, and 59.5% stocks. This has an expected return of 7.65% annually with a standard deviation of plus or minus 10%. Now, I thought that this was interesting because it's right in line with what many financial advisors tend to recommend people who are interested in crypto. Just 1% of your portfolio into crypto if you're interested. Now, for a more aggressive approach, we have the optimal portfolio. This is the one that maximizes the balance of both risk and reward. The allocation here is 25% crypto, 27.5% bonds, and 47.5% stocks. This has an expected return of 24% with a standard deviation of plus or minus 23%. Data says that this is the most optimal portfolio possible. However, it's important to note that while the MVP is great for reducing risk and the optimal is the best possible balance, there are several other options that are very close to optimal. We found that a 25% crypto allocation is optimal, but in reality, anything from around 16% to mid 30% yields very similar results. You can see these highlighted in the blue oval. So if your allocation is just a little bit off, it isn't the end of the world. We also need to mention that this only shows 3 major asset classes. This gets far more complicated if you added in like real estate to the mix or individual stocks, so this should be looked at as a kind of starting point for your portfolio. And of course, there are risks here. None of this is financial advice, first off, and these calculations are based on prior returns and volatility, so they cannot be perfect. Unfortunately, it's impossible to tell the future, and these models just can't take into account macroeconomic factors like war or Elon tweets. It assumes rational investing, which isn't always the case, and it assumes that returns follow a normal distribution. So while we can't tell the future, we still want to use all the tools at our disposal to make the best investment decisions possible. Because if we do that, we can be confident that we're making the best choice our ape brains can possibly make.